Welcome to the Daily Rip Live. I'm Ben Hunt. I'm filling in for Katie today. You'll know me as Holding Bags on Stocktwits, and always here Monday through Thursday. Shay Boloor. Shay, how's it going this morning?
Well, going well. Looking at the market's reaction to that very sizzling PPI reports, definitely digesting a bit, seeing how we're going to react to what was a really wonky surprise in the upside.
Yeah, just looking at the market right now in the pre-market, we've got the S&P down just a bit. We've got the Qs down just a bit. Crypto, surprisingly, or not surprisingly, I guess, if you anticipated a hot PPI, really sold off quite a bit after that print. Bitcoin's down around 4% right now. Um, I'm not the macro guy. I don't really pay attention to as much of these numbers maybe as other folks. But Shy, what's your take on these numbers, and how do you think? What do you think this means for the market the rest of this month maybe?
I think the market's reaction is actually a bit restrained if you look at the magnitude of the upside surprise in the inflation data. Like expectations are 2.5%. Him at 3.3. That's substantial. That's not even like you can something like it's a rounding error. Also, core PPI was even hotter at
Yep.
3.7%, over 3%. So these weren't just misses, they were purely inflationary shocks. And historically, a print like this would push out rate cut expectations, not pull them forward. It would cause a substantial market pullback due to front running something that isn't going to essentially happen in an accurate timeline that they were anticipating. But I do think that the market's timid reaction is highlighting what's a bigger factor right now, what's driving the market forward. Rate cuts are coming, whether or not Powell wants to admit it, whether or not these hot prints should push it down, it won't, because there is a political overlay that is overpowering the data here. If Powell's not going to cut rates, whoever backfills him and the new Fed chair is going to do that. So I think it's creating a setup where uh, the market's knowing that rate cuts are a priority for Trump. And with the Fed's independence already under pressure in the public narrative, I do think that the markets are treating the path to lower rates as inevitable. So even though this hiccup was a bump, I think that the bigger variable as well that is needs to be factored in is that September job revision is going to be a critical inflection point. I think it's going to probably continue knocking down the confidence in the strong labor market. We've seen these revisals like the past couple months of like, oh, it looks decent, way lower than we all anticipate. So I think that's as of right now, like investors, the market, traders are looking through this hot PPI print, betting that the political will for easier financial conditions will outweigh the risk of sticky inflation. Could this change? Yeah, absolutely. I think a couple more prints like this, not the PPI, but other macro data sets that indicate that inflation is very sticky. It might be ticking back up, and the labor market's deteriorating. Not deteriorating, but a hotter print is more like the reality than a one-off. Then maybe there's some kind of reset, but I think that right now there's a bias in political policy expectations towards rate cuts, and the market's seeing through the mess or the noise.
One thing that we talk about on our show, the Community Rip Live, Wednesday at 2 p.m. So tune in, check it out. JFDI and G Paiza and myself, we're constantly hammering the Fed because our show happens right during Fed announcements every week or every month, whenever they happen. And one thing that we've commented on is the Fed is always late to the party to start cuts or raise rates, and then they're always late to the party to start the cuts on the back end. And I kind of feel like that's the case still. So even though this number comes in a little bit hotter, that doesn't mean that September was guaranteed a rate cut, in my opinion. I think a lot of people were looking for September possibly as the rate cut. But I'm with you. I think it's inevitable that it happens, and you layer that political will on top, and it's not if, but when, basically.
Mm-hmm. No, exactly. And I think that the market's forward looking mechanism. This is backwards looking data. So I think that's uh listen, 3% is, I know the Fed kept saying 2%, 2%, 2%. I think that they they move the goalposts. It's not going to be just 2% for them anymore. So yeah, I mean, I want a pullback in the market. I think a lot of people would like a breather. Maybe not the short term traders, the zero DTE people, but I think for long term investors, uh, I think it's really important to get some kind of reality check. I think we're getting in specific sectors, but in the indices, like the clear winners of Robinhood's, Palantirs, like these names have just been running where it's been years in some instances where they haven't even broken the 200-day moving average. That is very rare. Like Palantir, Palantir's my top dog, like my number one holding.
I'm
They
gonna
just
pull up
have
the
not.
chart while you're talking about it.
Yeah, yeah. So Palantir just has not pulled back below their 200-day moving average in over 2 years. Like I don't know what the historical information for that is on if uh if it's that extended above that 200-day moving average. Like is it going to retest it eventually? Promise you guys, eventually every stock touches their 200-day moving average again. Either they consolidate, digest for an extended period of time, and that metric catches up, or there's some kind of one quarterly earnings that was just, oh, that was weird, and it causes an overfud on a pullback. We saw it right now with Trade Desk. We see it in Monday.com, etc. It happens. So I think for this one, like you're seeing, like what Ben's holding up, it's been for, look at that. That's crazy. It's like they ghosted the 200-day moving average and stopped hanging out with it. And now
Well, the last touch was back on Monday, August 5th,
the yen carry trade
2024. So a
crisis,
year ago.
yen carry trade crisis caused that a pullback right there. And guess what? It didn't even break it. Like when was the last time it actually broke it? You had to go back in 2023.
Yep.
Yeah, first quarter of 2023. So like it's an incredible run. But the last time the Palantir was under the 200-day moving average, it was under $10 the stock. That's a crazy stat. It's crazy, and it's not a cheap stock. I get it. Like it deserves it. It's AIP was the most successful AI application launch of this era so far. Maybe it will be for the whole theme in general. It's turning into like during the dot com era, the gems of that era was the online marketplaces, like the what Google and Amazon was able to build on top of it. AIP for Palantir might be that for this era, but doesn't mean that it can't just pull back a bit. I just think that right now, what's driving the stock up is the premium that institutions are having to pay to own the stock because you guys heard me talking about this. Like, if you are charging a fat fee for these high wealth clients and you have an AI bucket and you don't own Palantir, they're going to question your ability to find early disruptors. So, in order for them not to get that question asked for them, they're going to do some window dressing and buy this because they have to have this in their AI bucket. So, that's what's pushing the stock above $100, and who's continuing to buying it over $100. It's institutions. Dumb money paid a fair value. Institutions are paying the premium. It's kind of becoming a trend the past year or two. It's really interesting to monitor, but yeah,
I know when you're referring to dumb money as retail, in this case, the shoe's on the other foot.
yeah, 100%. And I think that the democratization of investing has accelerated the democratization of access to information. Like, I, guys, like the analysts on FinTwit, like people think that it's just Joe Schmo. Is like it's top. I see the institutional research and analysts on the other end. It's a lot closer than you think. Like it's real. There's some alpha on FinTwit right now on free analysts, and like this bullish one, I think I love to see this pullback. I think it's
Yep.
wild that Kathy Woods bought 2 million shares of this yesterday. I don't even know what price that is, but I it's I don't even know. Do you know what they do? I don't even know. Did not even look into them because that name of that company is just so absurd to me. That's
Yep.
just called bullish, and it's crazy.
Well, I think I pulled up bullish mainly because, we're seeing this pullback today off of this data, right? And who knows, in 15 minutes, we may get a tweet from the administration that they're firing whoever put these numbers together. But I bring this up because we've had a lot of deals, we've had a lot of IPOs drop, and you don't typically see that sort of M&A and IPO behavior in a weak market.
You don't. I think CoreWeave and Circle opened the door for a lot of companies now. Like that was like the real gut check of how appetizing the IPO market is for investors. And you saw both those names essentially have identical charts of 3xing, 4xing in a matter of months. So that opened
Insane.
it created there's a appetite for new companies for a while. It's been years since we had an IPO market that's been this healthy, where we had a flood of companies every single month. Like we did not have any in 2023, 2024. Now there's a backlog essentially of demand for companies that want to go public, especially in the crypto space where there's a lot of new crypto native companies like the that want to go public, that want to capitalize on Bitcoin, Ethereum. Bitcoin hitting all-time highs. Ethereum's
Well, Bullish
absolute
is one of
tear.
those names,
Yeah,
actually.
100%.
So I, I I don't know. You know more about what the institutions are doing than me. With the crypto, you know, play in bullish, is this something that folks on the institutional side, similar to your thesis on Palantir, like we have to have some skin in the game? Is this something that institutions start taking a nibble at, or do they sort of let it base out and see what it does first?
I think their priority is more on treasuries, actually. I think treasuries are becoming somewhat of a hot ticket where you're seeing strategy do what it's doing. I think you're seeing Tom Lee on BMNR do
Yep.
what he's doing. I think that I actually don't know what bullish does, which is probably why it's so hard for me to say answer that question. But I think that you're seeing institutions want to get crypto exposure, and there are so many like avenues to do that now. It's not just you have to buy the raw Ethereum crypto. There's so many derivatives of that. But look at that again. 200-day moving average is like such a great like. I
That was
get
the
that.
15-minute chart. Here's the daily.
Oh, the data. Okay, so I think that for me, I'm a fundamental guy. I have my technical hat on eventually. My biggest issue with technicals is you can change the time frame to fit whatever narrative you want. And
Sure.
I think that it's very tricky to see something a line in the sand of what's real, what's not, except for the 200-day moving average. I think that is one line where if you break it, you're in a stage 4 breakdown that has historically proven that's where money is lost. Stage 2 is when money is made. Stage 4 is when money is lost. United Healthcare, that isn't like, yes, it might be oversold in the near term, but it sliced through their 200 moving average. If you just sold right when it broke through 200-day moving average and it's like, all right, I'll rebuy once it gets back above it, you'd have saved 50%.
50%.
Like the same, like the lessons I learned during the 2021 2022 bubble bursting was sell below the 200-day moving average, sell everything, wait until the noise clears up, digestion happens, and then reallocate once things look a little perkier. And I lost 65% of my money in 1 year, and I'm a long-term investor in that year. I will never do that again. Like my hair is a lot hairy on my chest now because of that year. I'm not going to do it anymore. So I think for United Healthcare, for example, like it's not going to have a meta like bounce back. I'm sorry, it's not. It's very different industries. You guys don't know healthcare as much as I do. I've worked at this company for years as the director of corporate strategy. Like I know the obstacles of healthcare in the US of A. Like it's red tape bureaucracy times 100. Like if you guys think there's red tape bureaucracy, you guys have no idea how slow it moves. So this pullback that they've had is justified because the government is essentially telling them you're gonna do the same amount of work. We're gonna give you less money though. There's nothing they could do about it. Yes, they might have a bat line to the CMS, but the CMS can't just do something for United Healthcare, and they have to do it for everyone. And because of that, they're not going to. And I think that the V28 move is drastic, and it's going to take multiple years to phase out. It's not going to be a um, V shape where for Meta Zuckerberg, all it was user error, not user error, but like it was he just decided to turn the faucet off on investing in Reality Labs, and now he's going to focus on margin expansion opportunity. That legit takes weeks for him to do, and that's why it had a V-shaped recovery because he just prioritized shareholders over investments in AR and VR. It was all controllable. United Healthcare, what's happening there is not controllable for them. It's purely macro. So because of that, you can't compare them both of them together. I know it's very easy because they're both blue chips. They both like have feeded so quickly, so aggressively, so quickly, but different obstacles. So I think that United Health Group is undervalued in my opinion, but MedX is increasing. They're getting less money from the government.
Yeah.
You guys have no idea what the salaries are now for FTEs for doctors in that space. Like, it's getting up there, and that combined with the inability to make any quick pivots because they're so big that they're going to have a spotlight on anything they do if they want to do something aggressive or too quickly to offset the MedX stuff. That they are stuck in a way to like they have to phase it out, and this is excluding the lawsuits, which is still active. So like it's a mess. I parked some cash in there, which is really surprising. Everyone see like, what? Oh, you're talking all negative about this. Why are you parking cash in there? I have a huge cash position, unfortunately, in my growth portfolio, and all my high conviction names, they're not even close to the buy range for me. So like, where's the opportunity that I can maybe dump some cash? This offers a dividend. This is somewhat of this space is somewhat of a hedge on tech for some like it kind of is where if tech does pull back a bit, I do think the Dow names like the United Health groups are gonna catch somewhat of a bid as a scapegoat, but I also think it was daily oversold in the daily, and I think that there's a high floor on it when it was under 250 when I got in. Uh, will I? My price range was 290. I was going to probably take that profit. I'm happy with it, 15% of parking my cash, but I do think it's going to be trapped between like 250 to 350 for a very long time.
Yeah, one thing I always like to say is anything can trade, right? And that's why I like the technical aspect of trading because sure, I had the 15-minute chart up there, but I'm not trading intraday. So it's all time frame. And I think for UNH, a specific bullish case for those retail investors is okay, all these people, UNH is probably going to get a lot of new members because people are going to be off of Medicaid and some in cases of Medicare, right? But that's a long tailwind. That doesn't happen until 2026. And the money that they would be getting from new members doesn't equate the money that they're getting from the government. It's not a one-to-one, right? So it just makes it hard. So I think depending on your time frame, if you're looking at a short trade, sure, this could work. Are you looking to park money here for the long term? I mean, it is a lower beta name than some of your massive growth stocks.
Mhm.
But at the same time, if you're not expecting some type of pullback that would knock these high flyers off their pedestal, so to speak, UNH is going to be dead money unless that happens, basically.
Yeah, exactly. So I think it's really important to be aware of the arena you're getting into. And I think United Health Group will probably be fine long term. Listen, the US's biggest insurance company out there. It's too big to fail, truly is. Um, and I think that this with like it's really the healthcare space is very interesting because the bigger players are struggling significantly and the early disruptors are kind of catching a bit. We're talking Hims and Her Health. We're talking Oscar Health. Like these
We're
are
talking
names.
shitco summer, Shy. We're talking shitco summer.
Well, I think the story stocks. I think a lot of them are story stocks. They're like people are fed up with the irrational component of the healthcare space. And I think that if there's a company that's trying to disrupt it as a good story, there's almost a um, call to action on wanting them to do well. I think Nova Nordisk, looking at their chart versus Hims and Her Health, it's kind of crazy the difference. Like I know they're both like not purely GLP-1 plays, but Novo is a blue chip company. It's a really well run machine, and I
I
think
can't even
that's
find it.
yeah,
No,
it's tricky because of they're not a U based on US. I think it's right Novo Nordisk. Either way, Novo Nordisk is actually kind of catching somewhat of a bid though recently based on Eli Lilly's poor data. So on GLP-1, their
India.
GLP-1 drug. So by catching it, look how brutal it's been. Like I'm saying catching a bid, like it's not red. It's
There's the
it's like
200
up
weekly
10%.
for you.
Yeah. So I think that maybe they retested because they are currently the king of the GLP-1 data right now with Eli Lilly disappointing. I'm still waiting for Viking Therapeutic to drop their data. Like everyone is freaking it's supposed to be this quarter. Uh when is yeah, so like it could be any time. Nobody knows when. That might be a tailwind for Novo. It might be a headwind if Viking proves to be the best. But either way, Novo is got penalized so aggressively, and they're trading at 12 times earnings. So I think that was another place I parked my cash. It's weird. I'm a tech investor, guys. Like you guys know me. I'm growth, hyper growth, space, AI, quantum, electrification. I just don't see opportunities right now. I think the winners or the early disruptors in the space has been validated by the market via multiple expansion that I know people believe like continue paying for your winners, like keep feeding your winners. I just have a difficult time on feeding my Palantir position when it's that it's been years since it broke the 200-day moving average. Robinhood, it's $100 billion company right now. It's what almost tripled in a matter of months. I have a difficulty on participating when things are looking so rosy. Like I love buying when the VIX is at 50 plus. I hate buying when the VIX is at 14. That's just my style. I know people like think that this is when you're supposed to capitalize. Like you put the gas on the foot on the gas pedal. For me though, I like to do it when everyone's screaming, the world's on fire and like
Huh.
there's blood in the water. Like that's when I like to participate because there's usually disconnects. Right now, it's just it's too people are viewing this as too easy to make money. It's a sobering process being part of the stock market. They rug pull you all the time. And for me, I'm not, I have my list of names I want to get if the VIX gets a 30 plus score or that we finally tested 21-week EMA on the indices. But until then, I'm being patient.
So, do you think? First off, I hear that a lot, right? Of the market's overpriced. There's no fair value out there. Everything has gone parabolic. We're stretched over the moving averages. All those things are true, and I'm not discounting at all. But overbought can stay overbought just the same as oversold can stay oversold, right?
Mm-hmm.
And I think part of that creates the quote unquote wall of worry to keep grinding higher. And none of us know where that top is, just the same as it's always difficult to pick out the bottom and catch that knife at just the right spot. But what is it about this market that gives you some optimism? I'm hearing things why you're a little reticent to put money to work in some of these high growers. But what keeps you bullish at the end of the day?
Oh, AI is the main event. And I think that my thesis on AI has been from the beginning 2 years ago that this is not a product. This is a character change on society. It's going to touch every single sector, every single part of this world. In the beginning, 2 years ago, guys, like people truly thought AI was potentially 3D printing. Like they thought it was going to be a fad. Like that was a real thing. And I was like, that's absolute BS because 3D printing never had a consumer exposure where like everyone, like consumers, everyone was using ChatGPT when it got launched. Like it was like crazy boom. And I was like, okay, this is not 3D printing. And I was also in corporate strategy. I was like, my job is going to be replaced by AI because what I offer is intelligence to C-suite. That was my whole role is digesting data, creating a narrative, and communicating in an effective way to C-suite to do whatever they want to do to get ahead of this headwind or capitalize on the tailwind, etc. That's what AI was going to change. And I was like, I see a solvency risk now in my career. I think, and if I'm seeing it, I think as a lot more people are going to start seeing it as well, and that's why we're seeing the white collar job loss, etc. right now. But for AI, the reason I think we're in like year 2 or year 3 of a decade long rally, to be honest, is because there's going to be an indefinite demand for it. It's not going to be a cyclical thing where it just goes up a ton in the beginning and then it goes away. There's going to be a constant demand for AI. And yes, I think the hardware space of that might be a bit cyclical, where there's going to be an S curve where it goes up, digestion period, until something else happens in year 4 or 5 that they going to get another bid. But a lot of other applications out there, it's going to be permanent, consistent, constant. So that's why I think in this bull market, we have years and years ahead. I'm talking about the market always pulls back every 6 months to the 20-week EMA level. Like it just has like a weird 5% pullback. It's natural. It's just the name of the game. I'm just waiting for that to happen to participate. But I think right now for like my three most bullish names for stage two, the market's already validated them as a stage two AI winner. Like one of the companies that have a lifeboat from the AI tsunami, it's coming. The Palantirs, the Cloudflares, the Axons, those three names, they're like not pulling back at all. They're not even like, they're just, multiples are super expanded. And the reason for that is the market's, if you prove you have a lifeboat from the AI tsunami in this space, that they're going to give you a premium. And knowing that the demand is indefinite and we don't know the ceiling on AI yet. So if you prove that the high tide result boats, you're going to do just fine. If you don't prove that yet, and you're like, you might not even have a life jacket for the AI tsunami, you're getting destroyed. Look at Trade Desk, look at Monday.com. Like these are names because the market's re-rating that whole sector as you might be a commodity and you don't deserve to trade 40 times free cash flow anymore. It's maybe closer to 25 until you prove that you have a lifeboat. But the other names, the proven winners, they just haven't pulled back at all. And for me, I have very healthy positions in all three. So like I don't feel the need to add more. I'm looking elsewhere. And I'm still like waiting to get that exposure in Robinhood, Oklo, these like category leaders in maybe spaces that aren't purely AI. But yeah.
Yeah, I think it can be tough when you have a large cash position and you're
Mm,
waiting for those right opportunities. It can be to buy high and sell higher, but you're always wary of that rug pull, and especially if you're putting significant portions of your portfolio to work that was cash. Um, when you're at these elevated levels, it kind of, you got to balance that out in your mind, right? Is the juice worth the squeeze?
exactly. And I think that's like Axon, for example. Like Axon's my favorite thing you guys hear me talking about all the time is using anchored average VWAPs from Black Swan events. We've had two in the past year. Young Carry Trade Crisis, Terraforce. Terraforce anchored average VWAP for Axon was at 715. I'm going to probably be adding 7 at the 715 level. Next level is going to probably be, um, if we ever get to the Yen KHA crisis average VWAP, I'll add there, or the 200-day moving average. Like, look how perfectly it bounced there. Like, there's a reason. Like, it's just respected. I think algos respect the 200-day moving average like the Bible. So I think that's why it's like such an important line in the sand. But yeah, I mean, like this one over here, it's the yellow. Like, there's levels I'll add to it, and I think that's really important to like kind of have that conviction list of names that you want exposure in and monitor it via technicals and add to it. And I think that it's important to be sober with what your expectations on stocks a bit. And right now, just I don't know. I just wish it was a lot more difficult. A lot of people's egos are getting really big, like
Yep.
very big. So, and that's when it gets a little alarming, especially when you have names like Bullish Triple from an IPO, like right off the bat. And it's pulling back now, which is great, but it's just feels like it's too easy. You can buy any IPO that's gonna go public and you'll make money. That screams too easy for me.
Well, not just any IPO, any stock that it can be unprofitable. This is where we came in on our show with Shitco Summer and some of these names since early May have just been absolutely going crazy. You talked about hymns, but there's several names. Lemonade, Roku just recently fell after its earnings, but you never know when that's going to happen. You're going to have some that end up doing what Hims did and some that are going to fall flat on its face by Roku and sort of live by the sword, die by the sword in that vein.
Yeah, no, I totally agree with that sentiment. I'm looking at the market right now, and Amazon's up 1.5%. So I'm curious on why that is. They're really bucking this trend. I think they're only a big tech
The
company.
market just opened. We're down about a third of a percent right now on the Qs. Amazon currently up bigly. Wow, that's a huge gap on
Yeah,
Amazon.
it's a big
Um,
candle too. The right off the bat.
yep.
It
How much
can't be from
volume is
same day
forming?
grocery delivery. It's not that happened yesterday. I wonder if there's a positive note. Oh, you know what might be because of they're talking about their Tranium 3 and Tranium 4. Or yeah, that I think that might be. If you guys don't know what Tranium is, it's their custom silicon chip. You guys hear me talking about how every if you want to be a leader in the new digital economy, you need to have four things: data, hardware, distribution, next gen brain. Hardware is the one component for Amazon that's called Tranium. So I think they're the reason why they had such a confusing earnings report on their AWS business and why they didn't beat as much as like the Google Cloud, the Azures is what does Google have? Sixth generation TPU. Azure has uh, the open AI relationship, and it's just they get benefit from that substantially. Amazon tried really hard in the beginning to have train like to push for training their own custom silicon chips, not rely on Nvidia like their competitors did. That was such a mistake because now they are compute constraints, and that 18% growth on AWS, where people were wanting 20%, that was because of energy and compute constraint. It wasn't due to the demand. How do I know that? The backlog for AWS is growing at a 25% clip. That delta of 18% top line revenue, 25% backlog dip, it's mis misexecution from their management. That's why the AWS CEO got fired, I think, a year or two ago. It was a wrong play, wrong move. Eventually, yes, you have to own your own chips, but don't do it too quickly, too aggressively, because you'll miss on the demand supply surplus. So I think that's probably why it's catching a bit where we're getting some more commentary on Trinium 3. That's going to be hitting Q1 2026. And after that, I think they're even talking about Trinium 4. So like they're really pushing for that. Let's see what else. Honestly, I wouldn't be surprised. Qs might go green, which is crazy to me.
Yep, that's what I was watching with the strength in Amazon. Usually, it's hard for one mega cap to have that strong of a day and the Qs to stay down. So the Qs are up incrementally since just a moment ago, but we'll see how that plays out. Hey, Shy, one name that I saw that interested me in your Stocktwits stream was DigitalOcean. How does this fit with your play between Axon, Palantir, and Cloudflare?
Great question. Different lens. So DigitalOcean for me, they aren't going to be. They don't have a monopoly. Like Palantir, Axon, Cloudflare, they all have monopolies. What DigitalOcean is essentially is the cloud computing for SMBs. And I think that the reason I'm so aggressive, have been adding so aggressively to this name is they're trading at 10 times EBITDA multiple. And management has essentially called out quietly that they will be growing their top line 20% in 2027 while maintaining 35% EBITDA margins. That combination, there's no world you should be trading at 10 times EBITDA. And the reason they've gotten penalized so aggressively is everyone views them as an AWS light product. They think that the bigger whales are going to essentially eat them up. Uh, but there's a different story to be had here where also like they're only growing their top line 14%. So like why is Azure, Google Cloud, and AWS just outgrowing you that significantly more? Like you must not have a great offering. They just started really pushing their AI stuff past year. And you saw it right now with specifically their AI demand is exploding when we, for the first time, like they're doing, like they proved specific revenue on what the AI is going to be for them. They used to just be talking about, now they're actually showing it. I think their AI machine learning revenue grew over 100% year over year. I think that now they are saying that the AI is low teens percentage of their total revenue. They got 76 customers to migrate away from the hyperscalers to them. That shows to me that they're not just an SMB player. Their NDR, their net dollar retention, is going to 99%. You have to get that over 100%. It's still kind of ugly. But I just think that the AI is going to be such a massive tailwind for them that the market's not pricing that in accurately because it's not really proven in the top line of just growing 14%. But if you look under the hood, you hear the management talk about on their interviews and conference calls, they expect a massive reacceleration in a year or two. And that's after once they get the data centers up and running in Atlanta. Gradient is becoming a huge hub for all these AI agents that when the inference boom we're about to see is going to cause a demand bump for not the highest quality, but the most affordable offering. You're seeing that's why with AMD, for example, AMD's catching a bid because you don't have to care about quality as much in the inference era as much as you did in the training data era. Like that's why they're catching a bid. And you guys hear me saying all the time that inference is a tax on AI. That's how you make. That's what the inference boom is going to cause. Is the quantity is going to be ridiculous. I think DigitalOcean is going to catch a bid based on that inference boom where these customers don't want to pay up for Azure, AWS, and Google Cloud if they don't need to. This is a much cheaper offering that does just as much, if that, for the inference demand we're going to get. So I think that DigitalOcean is going to get a re-rating. I think that you saw first signs of that last week on their earnings report of, whoa, they got it up. They usually sandbag. And you saw they called out the AI specific metrics of why they're going to see a reacceleration. And I think that it's one name that's going to be 50 plus. I think due to the re-rating, and from there, technically it's going to break out if it clears like $50 because it's been on a multi-year base, and once it even crosses there, it's not even going to be expensive. So I think that this is like one of those names where if it trades at 25 times EBITDA, it's still fair, but it's kind of undervalued in my opinion if they're growing top line 20% and 35% EBITDA margins by end of 2027.
Yeah, I just threw up a quick chart. I like to see price behave in bases or channels, and I think above $30, this looks good. Again, anything can trade. I think the upper limit of your $51 price target lines up technically.
Yeah, and that's the thing. Like, it's also there's a very high floor in this stock because this is something a lot of companies will love to acquire to get that cloud computing component in their ecosystem. The millions of developers that use DigitalOcean, like I think that honestly, what would be really interesting is if Cloudflare acquired them. Like that would be a really like their CDN network with what they're doing with crawlers online. Like if they had a cloud component into their business model, like oof, that would be a really hot combination. So I
That
think that
was one reason why I threw Cloudflare into that mix. I know the names you hold. I obviously have position in Cloudflare too, but I was thinking that that would make a perfect merger in a
mhm.
a real world sense.
No, yeah, it could be them. It could be honestly, it could be ServiceNow. Like ServiceNow is a workflow engine. It's not, but they don't own any data. They're an application, and you guys hear me talking about nobody wants to live on SaaS Avenue anymore. Like there is everyone's trying to move out of that neighborhood into agentic cloud platform. How do you become accelerate that narrative? Like you owning a specific cloud feature underneath your ecosystems. Like maybe them, maybe Salesforce. That's a huge pivot from Salesforce. I don't think so, but I just think that everyone wants to own everything now in their vertical stack. Part of that might have to be the cloud, and what's the best way of doing that? There is a there's a cloud offering here, right here, that's trading at 10 times EBITDA or 12 times EBITDA probably after its move. But I just think it's a high floor. I think M&A is going to be on fire the next couple of years because there's going to be a lot of undervalued software companies, cloud companies that are being priced like they're going to drown from the AI tsunami. And the bigger players, they're going to benefit from because they have sticky moats that won't get uh, that have been in the works for decades that won't go away anytime soon. I'm talking IBM, I'm talking Cisco, I'm talking these kind of old as blue companies where they can capitalize. Like CyberArk got acquired by Palo Alto.
Yep.
Palo Alto is like the tier one cybersecurity name, like them CrowdStrike, and a lot of people want cybersecurity exposure because that's one of the safest and most explosive themes out there. People were still scared about acquiring Palo Alto because they paid 10x more than they ever did previously. But you guys, this is where the puck's heading. No identity, login stuff for security. It's not going to be humans. It's going to be AI agents. They have to buff up their offerings, and CyberArk is perfect synergy for that. Yes, they paid up for it, but in 5 years, the way AI is going, like 25 billion is going to look so ridiculously undervalued with how much is at play in the cybersecurity space.
And that's exactly where I was going. This was Palo Alto's largest investment ever.
Mm-hmm.
And for a company like that to all of a sudden take on a CyberArk when there were less expensive players that maybe they could have taken on, I think that really speaks well to where the leaders of these companies think that cyber is going. I mean, they're given 2.2 shares of Palo Alto and $45 on top of that for every one share CyberArk. And if you break down the arbitrage, that's a 3% discount by buying CyberArk stock if the deal goes through to get long Palo Alto, which is a trade I'm currently in, is trying to buy CyberArk because why wouldn't this deal go through? All the regulators are out the door with this administration. So unless they all of a sudden go off on some tangent about the administration or how the economy is poor, this deal is going to happen.
Well, also like cybersecurity space is highly fragmented. Like it's not a Microsoft has probably the strongest. It's the tier one. Like you guys hear me talking about like tier ones is Palo Alto, CrowdStrike. It's Microsoft's the best. I'm saying pure cybersecurity, but Microsoft is the best in that space. But it's highly competitive under the hood on all these different niches like log management, identity, endpoint, etc. Like these are there's dozens of names in each space. Like it's not as clear in the as you would think. So like I think this for sure goes through. I also think that Palo Alto, the reason I actually have a trade in Palo Alto as well, just because it went down 25%, I think, because of this deal, when I think long term it strengthens them significantly. They have to acquire their way to become a platform. And I think that you've seen they're adopting the Salesforce model when Salesforce became the early cloud disruptor. The way they sold their platformization was acquiring BI tools and putting into one umbrella, and then we are the we are a platform. Come to us for customer relation management. Palo Alto is essentially doing the same thing for cybersecurity. That comes at a cost. You just saw the recent cost, 25 bill. It's going to cost. They're going to probably make a couple more acquisitions because they just have not proven the ability to organically create new modules into their ecosystem. Where like CrowdStrike, they all organic. Everything they do is organically created. Where they have 9+ module adoptions across their customers, it's all organic. So they don't have to pay up to acquire the latest and greatest because they've proven their Falcon can just do that for them. Essentially, they have the right tools in the shed to do it. That's invaluable, especially when things move so quickly in the post AI world that you kind of have to have the ability to do things in house. Palo Alto has to acquire their way. That's fine. They're very open about that. They're not trying to sneak that in. But I think CrowdStrike's like a strength post outage and also last earnings report where it was like that was not a good earnings report. It was kind of like and it's really expensive, but they filled that gap like that. I think this is another classic example where they have a high moat and a theme that's got plenty of runway that is both offensive and defensive. It's going to go through a digestion period. It's not going to really catch a major bid. It feels like it's going to be hanging out here for uh, quite a while until that post outage hangover is over with, because their margins are anchored a bit on having to offer these like credits, etc., for the people that got affected, and it's affecting their margin profile. But yeah, this is a name where it's interesting to see, especially when it's gone down like it's been stuck for 3 months, I think, since their earnings report actually.
Yeah, and I think most of these names are going to be range bound for some time, if not the rest of this quarter through probably the end of the fiscal year.
Mm-hmm.
Part of that has to do with the approval of the Palo Alto CyberArk deal. We don't know when that'll happen. Best case scenario would be 6 to 9 months. That's about as quickly as these things usually happen. So when an investment happens, like one that Palo Alto is making, investors don't typically like to jump on that early, right? They sort of let that play out and read through before they re-engage with the stock. So I would expect at least 1 to 2 quarters at minimum to see some of this sort of frothing around in a range, and that sort of goes industry wide.
Yeah, no, I think that's healthy though too. I think a
Yes,
lot of people are just like, I want that 5% gains every month. I want to be up 50% every year, etc.
don't we
No,
all?
that's
Don't we all want
don't
that?
we all? But that's not how capitalism works. It's supposed to be a little more difficult than that, guys. So I think that you're seeing the crowd strikes consolidate. I think you're going to see Cloudflare consolidate, Axon consolidates. I think that that's fine because everyone else is kind of pulling back a bit in that space. So your consolidation is actually in a place of strength where you're not participating in the pullback. And the theme is going to be a massive tailwind for them. So like I think it's fine. Uh I am a little worried about like a Snowflake, for example, on their they're pricey on an they're even more pricey now because the whole space pulled back, and they are, I know for a fact, anecdotally, they are getting underpriced by Databricks in the private in these like client meetings because they don't have the luxury that Databricks has on being a private company. Like that, I think people underestimate how much of an advantage it is being a private company than a public company. You don't have to worry about your margin profile. You can spend as much as you want to get the tools necessary to increase your moats. The political headache of as a CEO and founder or whatever to report to the board every 3 months in a public fashion is it's just such a headache, and it slows down innovation. So for Databricks, they can underprice Snowflake on every single meeting, and it looks like top line revenue growth, and that's all they communicate. Nobody knows the really margin profile of Databricks. For Snowflake, they get scrutinized to a T every 3 months. So they can't have the luxury of underpricing it. They have a great moat, and 40% of the Fortune 500 companies store their data into their ecosystem that takes years to migrate out of. But they are kind of fighting a battle with the hyperscalers because hyperscalers have a similar solution, and Databricks on the other side. So I think this is a name that they have to prove they can grow 30% on the top line in order to maintain this multiple. If not, you've seen what happens in that whole space. They're going through a re-rating. If you don't prove you have a lifeboat from the AI tsunami, this is a name that I'm a little worried about. I own it. It's like a top 8 position for me just because I'm confident long term, and I love that data infrastructure's theme. Is just in the near term FUD. This is a name. This and MongoDB are names that I'm a little worried about this earnings cycle, especially seeing how strong reports are getting sold off in that space. Like JFrog was really strong. Datadog was actually a strong report. They both faded significantly.
Yeah, Datadog had a good report, and it kind of got hit a little bit, and still dropping. What's your outlook, and what are your thoughts on Datadog?
I think long term Datadog is a bit screwed. I think
A bit screwed.
screwed. Yeah, I think that I was bullish on Datadog a couple years ago. I turned bearish quickly as I digested more and more data and information of how the enterprise AI is trending. The reason I think they're screwed, again, they're not going to zero. I think they're going to be re-rated as a commodity a bit, where it's going to be 20 to 25 times free cash flow. Observability is a nice to have, not need to have tool for a third party. It's something that's very easy for AI native customers like OpenAI to create a similar offering of like, I'm going to make sure I don't overspend on my cloud. That's essentially what Datadog does for their clients. Don't like for cloud migration. There's a ton of companies still on prem. The cloud is a very sexy theme still. Everyone forgets about it, but a ton of companies are still not on cloud. So Datadog's whole spiel was we'll make sure you don't overspend it, and we'll also do all these different things for observability. AI agents could do 70% of that now, maybe even higher. Why pay up for the priciness of Datadog? Because it is pricey. They have an incredible go-to-market strategy, but it's actually one of the pricier offerings in that space. I think that it's going to be very difficult for them to grow 25% plus going forward. It's going to be more of a high teens growth story that's going to cause a re-rating of maybe 20 to 25 times multiple because they have really great margins. But it's one of those themes where the AI native customers get bigger and bigger. They're going to be like, we'll take it from here type of thing. And they'll create their own solutions because everyone wants to own everything in house. And that might be a victim to the AI tsunami. And it's something I think that you're seeing in the recent earnings report because I didn't see any holes in that print at all, except for that whole space is getting re-rated.
Yep.
And the thing about narrative re-ratings, they take the longest to
It's so hard to
shake out.
shake.
Yeah, it takes a long time.
Yep.
Like they have to really see something tangible to buck that narrative, and I just don't think we will any like in the matter of months. It's gonna. I really do think it's gonna take like over a year, maybe even 2 years to shake that narrative, or April of next year might be the first tell because this is the first budget cycle where we're entering the coming months where everyone's going to be deciding their 2026 budget on enterprise spend. We're going to those are the discussions that are being had now on where should we invest our next fiscal year's budget? Should we try to create our we need to cut down this we have our goal here. Where do we cut down? Third party spend on solutions that we probably don't really need that we overspent due to the board of directors telling the CEO, "What are you doing for AI?" And the CEO goes to the CTO, "Make sure you're doing stuff for AI and don't care about the spend." There was overspending in IT the past couple of years. There's going to be a reduction in that.
Yep.
So I think that you're going to see a real gut check on Q1 earnings of next year when everyone guides for the full year in the software space, who's kind of being a priority and who's getting deprioritized a bit. That's like the first test. So we'll see.
We're running out of time, but I would be reticent not to add in a quick hot take on Apple. There's so much going on with Apple. I mean, it's obviously bounced here pretty significantly over the last couple of weeks. What do you see with AI? It's AI, Apple with its AI hardware convergence. And where do you think this should be valued, or is it appropriate valued here just a couple percent above the 200-day?
Everyone in the space is side eyeing Apple because they just can't believe what they're doing on the AI space. Like they are just so comfortable in their comfort circle of just being a cash cow, which is great. Like they've done an incredible job going from a hardware company to a services company, and they're just printing cash in the meantime. However, they underestimated how explosive AI is going to be. I think they viewed it in the lens as 3D printing, to be honest. I really do think they underestimated how disruptive it's going to be and how necessary it is for them to capitalize on it because they're just making so much money on people's AirPods breaking a little so they have to get a new one. Like all their money is on refresh services, to be honest. I think like my charger, oh, there's a little wire sticking. I'm gonna buy a new one. iPhone, it's been a long time since I felt the need I have to buy an iPhone.
Right.
So I think their innovation has struggled. And I think that you're seeing their top AI talent leave ship as well to join the actual AI native environments that are disrupting that space. And I think for them, they're relying on their incredible mode of 2.4 billion devices out there that people are love the Apple ecosystem, but they're also underestimating how easily things can change due to a structural shift that's happening in society like AI, where I think scrolling on your phone is going to feel outdated in a decade or two. Like my kids, when they're teenagers, I think they're going to be like, you had to hold your phone and scroll to your apps. You didn't have to verbalize it. It wasn't like just around you. That's really weird. So I think that they need to prioritize it, which they sounds like they are going to. They have the best distribution out there. Remember that 4-pillar formula I said for leaders? They have incredible data, incredible distribution, zero next gen brain, zero hardware. So I think that the next gen brain is a component they have to prioritize. You're hearing perplexity conversations,
Yep.
but that's only going to be a variable, not end all be all. And I think that they are a hardware player. The next hardware for them that's a no brainer is clearly humanoids, robotics. Everyone has Apple devices in their homes. When why not have a humanoid for $30,000? And you have a Apple owns a home robotics space. I think that's like an easy lever for them to pull, but I just don't feel any confidence in their ability to innovate in a while. Like they spent 600, $700 billion in buybacks for the past couple of years. Why not allocate 25% of that towards R&D for AI? They would have stayed ahead in the game. It's just they don't view that as a big rock for them, and that's really worrisome. It really is.
So it sounds like this pop might be short lived, maybe.
Well, it's traded at over 30 times earnings. So like they're trading at what a moat should trade at, like when you have zero revenue growth in the top line. So I think it's fair valued. That's the issue. But like for you to think that it's going to go 250, you have to think that it's going to be trading at 35 to 40 times earnings on zero growth. So like there has to be some kind of second wind reacceleration on top line for you to believe that. And it's not going to be a super cycle on iPhones. I can promise you that.
Hey, Shy, I gotta say this was a lot of fun today. I really appreciate sitting in for Katie. I know you guys do tremendous work, so thanks for having me, guys. Just thanks again for watching. Thanks for tuning in. That'll do it for the Daily Rip Live. For Bags and Shy, we'll see you later.